Welcome back to the Global Ledger. I am Justin. In the last episode, we explored the discount rate, the bridge between money and valuation. Today, we're going to go a layer deep into this, and we're going to talk about why at the heart of every financial market, every asset price, every valuation model, there lies one simple question. What is the world willing to accept in exchange for taking risk? This question decides the level of an asset price, the cost of capital, the pricing of credit, how much leverage the system can carry, and how much markets move during stress. So risk premiums are where psychology meets the balance sheet, and you could even say liquidity meets confidence. And I would even go as far as saying the real economy, where the real economy meets funding markets. So let's unpack it clearly. So what a risk premium really is. Most people hear the phrase risk premium and think of a formula from a textbook, which is true, but in the real world, a risk premium is simply the extra return investors demand to hold an asset instead of holding the safest available alternative. And the safest available alternative is always, if you look at the top of the hierarchy, central bank money. Number one. Number two would be treasuries, and that would be kind of the safest collateral. So everything else carries a premium. From equities to corporate bonds, from mortgages to emerging markets, from crypto to commodities. So every asset contains some form of projected compensation for leaving safety. Risk premiums are those projections. So how do we interpret this from looking at this from a monetary viewpoint? Or should I say, from money? Risk premiums equals, I would say, the price of balance sheet space. So let's go a little deeper than what the textbooks probably would. So risk premiums aren't abstract. They're really at the core concrete. So they arise from the willingness of dealers and institutions, as an example, to use the space on their balance sheets to absorb risk. And that's really it. When balance sheets are flush with liquidity, when they're supported by funding that is stable, an easy hedge would be another one. And when balance sheets are profitable to expand, dealers tighten spreads, they absorb more risk, and risk premiums fall. And so on the inverse, when balance sheets are stretched or funding is expensive, collateral is, say, unstable, dealers will widen the spread. Shed risk, and this is how you see a rise in risk premiums. So this is why risk premiums are I call pro-cyclical. They compress in good times and explode in bad times. So let's talk about how risk premiums move markets, because it's not the other way around. So You'll read in textbooks that prices move because earnings change, right? But in practice, prices move because risk premiums change. You'll see this constantly. Stocks crash even when earnings rise. As an example, bonds rally even when inflation is up there. Markets have meltdowns. Despite weak data, or I should say, markets melt up despite weak data. Assets collapse even with positive news. So this kind of like feels irrational, but once you look at the balance sheets, it kind of starts to make a little bit more sense. So when risk premiums widen, this is the tightening of funding. This is because repo became more expensive, volatility spiked, collateral haircuts rose, hedging costs increase, and that capacity for the dealer to take risk shrinks. So when these kind of things happen, the market demands more compensation to hold risk. So prices must fall until the expected return matches that new premium. So it's not any kind of, there is some psychology embedded in it, but really this is plumbing. This is purely mechanical. So let's talk about the three core risk premiums. There are dozens of premiums, but three drive, I would say, the global system. Number one, probably the most important, liquidity premium. The extra return required because an asset may not be easy to sell. That is, in my opinion, the definition. Let me repeat that. So a liquidity premium is the extra return required because an asset may not be easy to sell. So when liquidity dries up, like we've said, spreads widen, discount rates rise, valuations drop. This is why liquidity shocks can drive crashes. Number two, I would say credit premium. This is the extra return required for default risk. So this is driven by earnings, leverage, cash flows, recession risk would be another, stress in funding, and collateral cycles. So when credit spreads are blown out or blowing out, it signals that the system is in pain. So number three, I would say equity risk premium. This is the extra return investors demand to own stocks instead of treasuries. This one ties. This is extremely tied to the equity market, and so equity risk premiums move up with, or I should say, move with fear, growth expectations, inflation, interest rates, but especially liquidity cycles. Equity risk premium is the ultimate bridge between money and valuation, I would say. So, let's talk about why these risk premiums may explode in a crisis. So during crises, everyone moves up the ladder. Deposits to treasuries, repo collateral to reserves, risk assets to cash. This flight to safety kind of forces higher haircuts, volatility, definitely higher funding cost, and again, lower dealer capacity, higher margin requirements. So as balance sheets shrink, dealers are demanding more consumption to hold risk. So risk premiums explode. This is why markets drop before news breaks and spreads widen instantly, and credit freezes, really regardless of fundamentals. So risk premiums kind of lead the crises, and not the other way around. So this understanding risk premiums, what they are, and how they interact with the market and valuations and monetary policy and dealers and so on and so forth, removes the fear of financial markets, and it takes the emotional part out of it, and it helps because when you see risk premiums as the price of safety, the cost of funding, and the measure of balance sheet stress, everything looks more mechanical. So they're not magic or anything like that. It's accounting, and that's what makes them predictable. So thank you for listening to episode 11 of the Global Ledger. We clarified how markets decide what risk is worth. Again, not through emotion or anything like that, but through balance sheets, funding, and liquidity. So in episode 12, we'll build on top of this a little further. We're going to talk about yield curves, the market's map, I would say, of the future. So once again, I'm Justin, and thanks for being here.